Good evening. I'm Curtis McKittrick, and tonight I'll be talking a little bit about an option strategy known as writing covered calls. So, in one of our recent videos, we went over a little bit about how put contracts can help you ensure the value of a large block of stock that you hold. Tonight, we'll be talking about a different dimension to what options are and how you can employ them in your investment strategy. So, I'm going to start this with the same chart we used in the last video. I picked this security here that's an example of a stock that is relatively stable compared to others that are in the market. If you notice, again, on the right, the prices for this range between about $65 and about $95 over a 5-year time period, which that is, compared to most stocks in the market, that is very stable. So I picked this stock because it is a very good example of what the most stable stock you can get is going to look like. With that said, we've probably noticed by now, by the shape of this line, even a relatively stable stock, it does move around a little bit. And sometimes the ups and the downs can be fairly precipitous. And, some people might look at that and worry a little bit. Will this affect me? Am I going to get caught by a price move against me at the wrong time? Well, it's a good question. And whether or not you're one of those people, what's important about the strategy we're talking about tonight is that there are other people in the market who are worried about the price going in a certain direction at a time that's inconvenient for them. To be specific, these are people who are worried that the price might go up at a bad time. These are people who, for any of a variety of reasons that we can get into at another time, they intend to buy stock at a certain time in the future, and they're worried that at that time the price might be higher than it is now. So we can work together with these people to help both of us achieve our objectives. So again, in the last video, we talked a little bit about how you can use put contracts as insurance to protect yourself. Now, with this strategy that we're talking about here, writing covered calls, we're essentially taking the other side of that. We're acting as the insurance company, and we're helping other people manage risk. Now, it works out pretty well for us because the risk that these people are worried about is that the price might go up. Right? We'd be really happy if the price went up because we own the stock. So, our gain can help them out a little bit. So I'm just going to pause here for a minute before we get a little further into this. And when I start to discuss options, something that people often say to me is, well, it's a zero-sum game. If I win, someone else loses. And, the objective of my investment strategy should just be to make sure that I'm always the winner. That's not really the right way to think about this strategy of writing covered calls. Better way to think about it is that you and someone else are both winners, but you agree to divide the win between both of you. So what you end up doing with this strategy, you're really just, you're splitting your win with someone else. And that can have a couple different advantages depending on what your investment strategy is. So where this strategy tends to be particularly helpful is when you own a stock that you don't want to take big risks with. You're a conservative investor, no big risks, but you do want to see some modest growth in that, at the very least, to keep up with inflation. And ideally, you'd like to take out some of the risk of owning all this stock. Well, this is a strategy that helps you accomplish that. Let's take a look here. So this is what is called an options chain for this stock. So this chart and this options chain, which is essentially a chart for options, they're from the same trading day. So if we look at the price on the day in question here, this stock closed at $77.24. Let's say there's someone in the market right now that they need to buy this stock exactly a week from today. And they only have $78 budgeted for that. They might buy one of these contracts that would be very useful to them. And we'd like that too, because let's say we sold them that contract and the contract is exercised by the holder. We still make a profit on our stock. It's potentially less of a profit than we would make if we just held the stock long-term, but we still make a profit on it. So again, just to tie this back to what I said before, Best way to think about this strategy of writing covered calls is not that there's going to be a winner and a loser, but you're agreeing to divide the win between two different people. So let's take another look here at this chart. So what this chain is, this shows the price of different options that you can buy on this stock with an expiration date of January 20th of 2023. So these are a special type of long-term options known as LEAPs. Most people in the options market are concerned about things that will happen anywhere from a couple days to maybe a month or two from now. This example here, it just shows what's called a long-dated option, as it's referred to. So this is an option that it has an expiration date pretty far in the future. So let's say you own 100 shares of this stock here. Shares worth about $77.24. And you make a decision that you'd be pretty happy with how your investment worked out if those shares sold for, I don't know, $80. So let's take a look here. So if we find a contract, you're going to write a contract that someone else in the market will buy. So you'll sell this contract in the market. And whoever buys it from you is buying the right to purchase 100 shares from you at $80 per share. Let's move a little over to the left there. So we see that per share, you would be paid $4.18 for that. The contract covers 100 shares. So you would receive an upfront cash payment of $418 today if you sold that contract today and you had 100 shares of stock. So if you have 100 shares of this, we said before, the market goes up, it goes down. For us as an investor that's holding it for the long term, the fundamental idea of buying stock is that you buy it at some price and you'll sell it at some price that's higher. We hope that the price goes up. Something that is a bit of a risk in that is that even if we're correct and the price does go up, it might go up tomorrow, might go up 13 years from now. So it can take us a long time to achieve that objective, even if we are right, which is not guaranteed either. But let's say we own this stock today, we turn around same day, we sell this contract that gives someone else the right to buy the stock from us at $80. We get a payment today of $418, all right? So like we said before, the price may in fact go above $80 at some point, and we would miss out on a large part of that. But we lock in a gain of $418 today. So depending on exactly what our investment objectives are, this can work out pretty well compared to just buying and holding the stock. Now, another thing I'd like to point out here is that if you employ this strategy, it does require you to own the stock. And that does carry the risk that the stock can fall in value. But let's say that for whatever reason, you are going to own this stock. Let's compare two different investors. Let's say we have one investor who just buys the stock today and they're just going to hold it for some indeterminate period of time and hope that the price goes up. All right. And then on the other hand, we have you. You have the stock and you start selling covered call contracts today. You face less risk than the first investor because both of you bear exactly the same risk that the price will fall. You both own the stock, you're both in the same market, and you'll both be affected to the same degree by reductions in price. But the difference between you and that first investor is that you got an upfront payment on some of this stock. And the price can fall a little bit before you face any loss on that. So some of the risk that you bear by owning the stock is reduced by this strategy. So just to recap, selling covered calls is a strategy that you can use to get modest income on holding a stock, and you get lower but more predictable income from it during the time that you hold it. And it helps to hedge against some, but not all, of the risk that you face just by holding that stock. And the last point I want to make here is that if you have a reason, whether it be financial or otherwise, that you don't want to sell the stock, don't use this strategy, because you have to be comfortable with and accept the possibility of selling your shares if you employ this strategy. So what I generally advise my clients to do, and they're selling calls like this, is pick some price at which you would be perfectly happy to see the shares go. So let's say you bought this stock for $77 and you said, you know what, if I was able to sell this stock for $86 and sleep well at night, I'd be happy with that. That will serve you well. If that's your thinking on a share of stock that you own, this strategy can work very well for you, because you have to look at it as, well, let's say I buy my share. Well, of course, I hope it goes up to $1 million a share. It's not likely to happen though. So is it better for me to just hold a stock for infinity and hope that the price goes to the moon? Or would it be better to turn around and sell this call contract today and get a payment of known size in my account today? That really depends a lot on who you are and your personal situation. And if you think this is something that could help you, let's sit down and talk about how this strategy fits into your investment objectives. And we can get a little bit more into the details, because there's lots of different prices and different ways you can sell the contracts. We'll have a lot to discuss there, but I do hope that I've given you a good understanding of what this strategy is, and just showing you another option that you have for generating modest, low risk, and fairly predictable income from the stock market. So again, if you have any more questions, please give us a call. Be happy to help you out, sit down together and figure out what we're going to do. Thank you for joining tonight.